to this edition of Hardman Talks. My name's Mike Foster. I cover property here at Hardman Co, and I'm the Yew Grove analyst. Yew Grove had results late last month, very good results. So please do take a look at our post-results research, which is available on the Hardman Co website, a new report out this morning. I'm pleased to be joined today by Yew Grove's CEO, Jonathan Laredo, and CFO, Charles Peach. So in terms of today, this is a follow-up to an earlier webinar that we did some months ago. Yew Grove released some strong interim results showing a dividend rise and, as ever, near 100% rent collection. Just to remind you that the NAV rose in calendar 2020, which is quite an important feature, and there was another accelerating rise in these first half numbers, and some very interesting points in the first half numbers. With that, I'll hand you over to Jonathan.
Thank you, Mike. And thank you for the very nice introduction. Because I've talked about the background to Yew Grove and our strategy before, I will be reasonably brief on the introduction. Charles will then take you through the highlights of the 6 months results with a little bit of color on our performance since IPO. And then I will touch on the way in which we've managed to improve valuations, specifically through asset management. Yew Grove is the only REIT in Ireland which is focused outside of the centre of Dublin. And our focus is on industrial buildings and offices which are appropriate for multinationals or government bodies situated outside of the CBD of Dublin. We've been doing this now for 7 years, just over 3 years as a public company. And we've bought, we're internally managed, and we bought 5.5 million shares. So we own just under 4.5% of the company. The dividends are supported by a very strong rental, and we pay them quarterly, and Charles will talk about those in due course. But as importantly, it's no good having higher dividends if the value of the company goes down. And so we're very focused on maintaining and improving that capital value. And I will talk about later about how that is driven by asset management. The next page covers in some detail the economic drivers of this situation. I've talked about this before, but by and large, the economic background is driven by Ireland's success as an economy, and in particular, the success of the inward investment policy, which has been followed by successive governments for many years. In the last 20, in particular, they've focused on bringing into the country high growth industries such as medical technology, life sciences, technology, advanced engineering. Those industries have clustered around the country. More than 50% of investment is outside of Dublin, and they've clustered in like-minded groups around the country. Because the financial crisis created a shortage of properties, and because that has not really been solved through building, because there's been so little construction, there is a shortage of properties, and there is a surplus of very strong tenants looking for property. That means rents are increasing, and there is a very healthy economy for a landlord. Finally, when we look at our portfolio, which I'll touch on in more detail, you will see we've built a very strong portfolio of tenants, a very strong portfolio of buildings, and we're in a very good position for future growth. With that, I'm going to pass to Charles, who will take you through the key financial numbers in the last 6 months.
Thank you, Jonathan. If we look on this slide, in the top left-hand side is a reasonably good description of what we've done in the first 6 months of the year. We started off with an IFRS NAV of just over 100 cents per share. Throughout the period, we had strong collections, over 99% collections on our rent. So that leads to our strong rental income. Jonathan's mentioned before that we ourselves have our own money invested in this company, and we are very keen on keeping the costs at an appropriate level for that. So we kept a lid on costs you see in the admin and finance chart. In the period, in order to be an Irish REIT, you have to list on an EU main exchange within 3 years. We did that this year, and that cost of doing so is shown under the exceptional item. That net rental income after costs we paid out to our shareholders in dividends. And dividends quarterly for Q4 2020 and Q1 2021 are included in dividends per share of 2.65 shown here. We made acquisition costs as we purchased further assets in the period. However, we made a valuation gain on our assets that exceeded those acquisition costs, improving our NAV. And even after the costs of issuing further equity as the company grew, we showed an increase in NAV over the period from the earlier 100.03 to 100.64. While our NAV grew, at the same time, our rent roll grew, and that's shown on the right-hand side here. It grew from 10.9 million at the beginning of the year to 12.8 million at the half-year point. The vast majority of that was through the purchase of assets, which we'll mention a little bit more later on. However, we continued to lease vacancy, leaving us with a half-year vacancy rate of 4.7%, and at the same time make changes to our current leases to both increase the rent roll slightly, but at the same time to extend the tenor of our leases by half a year to the break and 0.6 year to the lease final point. The next page looks at the growth we've had in the portfolio and at the same time the rent roll since IPO in June 2018. The portfolio has grown by 6.5 times over that period. Yet throughout that, what we have concentrated on doing is doing what we said we'd do at the beginning and achieving the same or similar yields to those we had at the beginning. As such, the rent roll has grown pretty much in lockstep with the portfolio. And we have a pipeline of future, which we'd like to think would increase in that way. At the same time, however, that looks at what our current rent roll is. If we look a little more in the future, we have to see what the market might provide on our current assets. And that's shown in the bottom right-hand of these charts. You'll note here a brown line that goes from the lower left towards the right. What that shows is the initial over-rental and subsequent flat under-rental of our portfolio. Early on at IPO, when we had a very small portfolio, there was a benefit to being over-rented. Since then, we've been under-rented, such that the market rent on our assets is greater than the current rent we receive. And the split between that under-rental amount is split fairly evenly between some vacancy, which could be let at the market rate, which we work on, and at the same time, some of our tenants who are paying leases which are currently under the market rate. And as we come to rent reviews and other lease events, we look to gain that extra benefit. So while we have a portfolio with strong rental income coming from it, we look for opportunities to increase that from our in-place tenants, those ones who provided us with those 99% collections. So while we look to improve our rental income, at the same time, I mentioned before, we keep a grip on costs. Bottom left shows annualized administrative costs over our portfolio size. In the first half of this year, we had the exceptional item, which increased that. However, if I were to compare without that exceptional item to give an idea of run rate, it fell from 2.2% December 20 to 2% when annualized at June 21. So the net rental income followed by, after all the costs, means that we have amounts that can be paid to dividends. And we've been paying quarterly dividends to shareholders since the first quarter of 2019. Even though we've taken on this exceptional cost, we still continue to pay out that quarterly dividend. And we target in or around our EPRA earnings per share distributed to shareholders. But at the same time, while some describe us as an income REIT, we are very keen at the same time on the value of our assets and maintaining and improving that. The bottom part of this slide shows the like-for-like portfolio valuation change. And this is key. When we purchase assets, we suffer about 8.5% in purchase costs, the vast majority of which is the 7.5% stamp tax. We therefore have to target to recover this, and we generally aim to recover that value over 3 years. So we can go back to the beginning of 2019. In 2018, we had a relatively small portfolio, but from the beginning of 2019 to now, over that 2.5 year period, how have we done in recovering those costs on our in-place portfolio? And if we look across the portfolio itself, over the 2.5 years, we've had an increase of 10.4%. And from the office, that's been 7.3% to date. So we have a little more growth to get to our target in the second half of this year, and the industrial substantially more than that. So what this shows is we've continued to pay quarterly dividends to our shareholders, even through a pandemic. In each period shown here, we've shown growth of our assets in portfolio, and at the same time, both office and industrial. This is a summary of our income statement, but considering the impact of the exceptional item of listing on the main board of Euronext, which we definitely do not expect to go through again, we've split out the first half of this year, excluding the exceptional, in the centre column. What you will see is, you see when compared with the first half in 2020, an improvement in rental income, the majority of which is through the purchase of new assets, a slight increase in property expenses as the portfolio grew and we maintained our assets. We have a significant increase in fair value gains on investment properties. The first half of last year, we had significant purchases. The first half of this year, we had some purchases. However, our gains on the portfolio significantly outstripped those, such that at the end of the first half, we showed total income of 7.8 million euros versus 3.5 in the first half of last year. On the cost side of it, our administration and admin costs were broadly the same as the prior period. We had the main board exceptional expense. Finance costs were relatively the same, meaning that our profit for the period for the first half of this year, 5.7 million euros, would have been 5.6 without the exceptional, significantly up on the 1.3 of the prior period. Meaning for the first half of 2021, our basic earnings per share were a shade under 4 cents per share, and dividends declared from the period's earnings were 2.55 cents per share, compared with 2.45 cents per share for the prior period, an increase. A summary of the balance sheet is shown now, and we show, I think, 3 key things. The first of which is growth in the portfolio, partly from the purchase of assets, but also from that like-to-like valuation gain. At the same time, however, while looking to increase the size of our portfolio and the rental income from it, we also looked at each asset to see, is that asset doing what we want to have of it? And that's why further down you'll see under investment properties held for sale, 4.1 million euros. We had 3 non-core assets which had a small element of retail exposure within those. These were held for sale at the half-year point. Within a month of that point, 2 of those assets had been sold, and the last third of that asset we expect to sell by the end of this year, after which our portfolio will consist of only industrial and office assets with no retail. So we have growth. We will eliminate the retail from our portfolio. But at the same time, one of the things that we have learned, particularly from the pandemic, is people's appreciation of liquidity. Cash and cash equivalents is up on where it was in the first half of last year. We made further drawings on our debt facility that grew from 38.5 to 49.6 million euros. We still have 4 million euros outstanding on that debt facility as at the moment, with the potential to increase the size of that facility. Our loan-to-value ratio at the half-year point was a shade under 30%, and on a net debt perspective, our loan-to-value ratio was just under 23%. If I take all those together, at the bottom you see the figures you'll recognise from our NAV progression from before, from 100.03 at the end of December to 100.64 at the end of the half-year period. So where does this leave us? This leaves us with other projects still for us to do. First of which is to increase the revenue from our in-place portfolio by letting the vacancy that we have, by working on the reversion we have with our tenants. I would mention that the reversionary numbers and ERVs that we show in here are not the company's opinion. These come from our third-party independent valuers who provide them to ourselves. We at the same time have a development project which is ongoing at the moment, that is on time and on budget. We expect that to be finished in the first half of next year, at which point an agreement for lease will come in with the tenant, and we expect to receive revenue from that point onwards. Last of which is we look to grow the portfolio and to grow the company. We've shown our ability to grow the company without a commensurate increase in the administrative costs. We're an internally managed REIT, and we keep a tight grip on those costs. The further we grow, we hope to increase that quarterly dividend paid to shareholders and demonstrate the operational leverage there is within the company. But chiefly for the performance of the company is the performance from the underlying assets themselves and the portfolio. So I'll turn over to Jonathan now to take more on the portfolio.
Over the next 10 minutes or so, I'm going to take you through the highlights in the portfolio and give you some examples of how we have increased rents and value. This page shows you some of the key metrics of the portfolio. On the right-hand side, you see our 10 largest clients. These are all either government bodies or very large multinational businesses. For example, Optum Health is part of the world's biggest life science health company. ESB is the electricity supply board of Ireland. We have 164 million of properties, just under 920,000 square feet. Yield to the company, which is the current rental divided by the current value, is 7.5%. And the reversionary yield is the amount, the percentage that would be if all of our vacancy, which you can see is under 5%, was let and all of our rents were at market rent. Couple of notable points: 32% of our rent roll is from life science tenants, and approximately 78% of our rent roll is from offices. If we go to the next page, you'll see a map of Ireland and where our buildings are. The little box on the right-hand side of Ireland shows our Dublin suburban and commutable properties. That's about 55% of our rent roll. The rest of our properties are situated in clusters around some of the key business parks or cities in the country. Then we go to the next couple of pages. What we've tried to do is to illustrate how, in this example, we managed to keep growing the value of our offices. All of you will be aware that the pandemic has thrown a fairly sharp light on office values as people debate whether working from home will affect office values. And what we've done is we've looked at our regional office portfolio. The same thing is true of our Dublin office portfolio. The rental levels are different and therefore it would skew the graphs. But the two graphs on the right-hand side illustrate the situation. In the top graph, you see in the bar charts the actual rent received and which is the grey scale, and the dark green scale is what the third-party valuer sees as the ERV. Through time, those numbers have climbed. However, even today, the rents are at around, the ERV is around €16.50. For competitive buildings to be built in the areas we are operating, rents need to be up around the €24 a square foot level. So we are still well below those levels, and there is still lots of room for growth. More interestingly, the discount rate which the third-party valuers apply to the calculation has not tightened during our period of ownership as a public company. And what that says to me is that the value increases you see below are not driven by a discount tightening, they're driven by asset management. What you can see in the graph below, the dark green line, is the capital value per square foot of these offices, which has grown on the right-hand scale from around €155 per square foot to around €185 a square foot. It's quite clear that it's not from discounts, as you can see above. It's from a reduction in vacancy, which you can see in this chart, and an increase in yield. So in summary, the value increases we have driven through our offices are through asset management, not through market change. If we go to the next page, you see a slightly different story. This is the industrial portfolio. Our industrial portfolio is made up of life science buildings and more traditional industrial buildings. By and large, there has not been very much asset management yet. And that is not because we don't do asset management. It's because the leases in place have only had one rent review up to the period of June, and there have been no opportunities to manage those properties. That is beginning to change. However, during the period, the change in rents was all through acquisition rather than through asset management. But you can see the ERVs have been climbing steadily. Demand for industrial properties has been climbing steadily. At the same time, the discount rates applied by the valuers have been tightening. And as a result, we have seen an increase in valuation. Interesting, I only say this one thing. Interestingly, secondary transaction in the industrial market suggests that brand new properties are trading at around a discount rate of 4.5%, and good quality secondary properties at around 5.5%. Our properties are still valued at a discount rate higher than that, which suggests to me there may be further growth. Over the next 2 pages, we've got examples of the asset management we're doing. This page illustrates the development that Charles referred to. The top right-hand picture you can see on the screen is our campus in Athlone. All of our tenants are our medical technology companies on a site which is populated only by medical technology companies. The key reason we show this is that those companies are all growing. The pandemic has accelerated that growth. However, there is no capacity for them to grow into. And in the local area, and even in a wide sort of geographic area, 50 miles either way, there are no suitable alternative places for them to move. So if somebody is growing, their choices are to find somebody to construct new offices. That's what's happening. We are building an extension of approximately 35 to 37,000 square feet, 35,500 usable square feet onto building B. You can see a picture of the developments in the middle. You can see a nice little graphic of what it will look like at the bottom. That will cost us approximately 10 million euros, and we have an agreement for lease on completion of 950,000. A very, very nice return, better than we can get in the secondary market. Here's an illustration of the asset management we do in our office portfolio, slightly different. We bought these 6 offices on Millennium Park in February 2020. We agreed the purchase in November 2019. When we bought them, one of the offices, 40,000 square feet out of 140,000, was vacant. At the time we bought them, the agents believed the market value, the ERV, was approximately €15.50. We let the vacant building in July 2020, 3 months into the pandemic, when nobody was in the office. We let that to holding. We let it on a 15-year lease with a first break at 10 years at a rent of €16.50, thereby franking or improving the ERV seen by our valuers. Since that time, we have done a number of asset management activities, all listed down on this slide, the last of which is a rent review at €19. The reason the rent has been rising is there is no vacancy anymore on this site. We are getting lots of incoming requests. It's a very popular site. Active asset management is improving rent. You can see from the acquisition at 25.3 million, the latest valuation is 27.3 million. That is a yield to the company of 8.9%, a yield at NIY of 8.2%, which is, in my view, very, very generous. There is lots of growth left in this portfolio, in fact. Here are the examples of the properties we have bought during 2021. The top is a brand new industrial unit in Dundalk, which was an addition to an industrial unit built in 2016-17. We paid 8 million, the NIY 6.9%. The reason I think this is a great transaction, it's got a very strong tenant, is if this had been available in a very active public bid situation, we would have been forced to pay 5% or thereabouts. It's a great transaction with real value for us. In the bottom half of the slide, you can see 2 offices on a business park, City West Business Park in Dublin, one of Dublin's premier business parks. Those buildings are a good example of offices fully let to multinationals bought at a very nice price with an NIY of 8.2%, but more importantly, under rented. There is real value, reversionary value, and real opportunity to exercise asset management to increase the value of those properties. So, in summary, we manage the properties to manage the office properties to increase the value. We buy industrial and life sciences buildings because we see value in those buildings, and we will asset management and them when the opportunity comes up. The areas in which we operate have very low vacancy and very high demand. And what we see in front of us is a large portfolio of potential purchases which will be accretive in income terms and should be valuable in capital terms over the near future. The issue for this company is equity, capital. We have some capital available on our balance sheet, but not very much. And what we would like to do is grow and take advantage of the operational leverage in the company. And with that, I will open to questions.
Thank you, Jonathan and Charles. Got an initial question actually on the Athlone extension, I suppose, build. Presumably that is pre-let, and if so, did that not rebase rental levels higher and lead to, and has that led to a big uplift in valuation on the rents and on the capital value?
No, Mike, you're absolutely right. It was pre-let. We wouldn't enter into any transaction like that until we'd agreed an agreement for lease, which kicks in on completion. However, that does not lead to a rebasing. And part of the reason for this is that the valuers take the view that while it's in construction, the right way to value it is to look at the construction value and look at the value of the construction in the ground. So what they do is they try to value the construction as is and compare that to how much we'd spent. They won't look at it as an investment property until it's completed and the rent and the lease is in place. So until this is completed, circa March next year, this will continue to be neutral in our balance sheets, slightly positive, slightly negative, but neutral in cash flow terms. Once it's completed, it will then become an investment property and will be the valuation will change.
I had one other, which was about the life sciences valuations again. And actually it ties into something that I noticed on the industrials rental levels. So a bit of a two-part one, the second part being from me. But the first part was that there hadn't been an increase in the valuation really of the life sciences part of the portfolio. And was that a surprise or was it a worry in that they should presumably be much higher quality? And then the point from me was, so you, I think if I got it right, mentioned in the presentation that the ERV for industrial hadn't gone up for a year and a half because there hadn't really been many lease events. But I may have got that wrong. So it's really broadening out to the industrial. How much scope for uplift on rents would there be? And then the other thing was about the valuation on the medtech within the industrial not going up.
Yeah, so there are two questions there. One is the valuation of the life sciences, and the other one is rents on the industrials in general. And so let's just unpack that. In the life science buildings, we're not worried that you're right. There has been only a marginal increase in the valuations we receive for life sciences. And that is in very deep contrast to, for example, what's happening in the UK, where life sciences buildings have increased dramatically in value. That is really a function of the way valuers look at these buildings. In the UK, in Ireland, anywhere else, valuers, when a sector begins developing as a new sector, they don't change their valuations until they see market transactions. And so if you look at the UK, for example, and you go back 2 years, those buildings on the Cambridge and Oxford Science Parks were not valued, they were discounted at 5.5%, 6% or thereabouts, and were considered unexceptional. As people, and using Blackstone as an example, as there was more and more interest in those buildings and people bought them at more and more acute levels, so valuers decided they should revalue based upon buildings which are attractive to life science investors, and those discount rates have tightened to 3.5% or thereabouts. In Ireland, Ireland is clearly a smaller market than the UK, and the UK began in late 19, early 20. Ireland has suffered a much more severe lockdown. People have not been, until August this year, people were not traveling to Ireland. So the idea that you should inspect building and people can do transactions just is not that simple, especially given the fact these buildings are generally on business parks, not in cities. So they're not easily accessible. So we did not expect those values to change. They will only really begin to change dramatically as opposed to gradually when we see transactions. We've talked to the valuers about this. The valuers understand and recognize what may be coming, but have said until such time as they see transactions, these will be valued as if they were industrial buildings with significant expenditure internally, which they cannot put a value on. So a box with lots of laboratories in it is actually, slightly ironically today, less valuable than a box with nothing inside it. That will change when they see transactions, so I'm not worried. It'll just take time. The question you asked about ERVs, it wasn't ERVs that didn't change, the actual rents didn't change. We had properties which there were no rent reviews during a period, and therefore the only change in our actual rents were when we had a new purchase. The ERVs gradually increased. We actually are in the middle of a series of asset management activities at the moment, and things will change in some way. If you look at the market for rents in industrial properties has been slowly increasing. When we went public, by and large, the ERV for a secondary industrial property would have been in the order of 45 euros a square foot. Today, it's more like 750 euros a square foot. A brand new building in 2018 would have been about 650, 7 euros a square foot. Today, it's closer to 10 euros a square foot. So there has been a change in those rents. We are approaching the end of that change for classic industrial properties. And what you're seeing in those properties is WALT extending, as you'd expect. In our properties, we still have to increase the WALTs through asset management. We have a little bit of way to go to increase the actual rents through asset management, and that will help increase values. Discount rates in our non-life sciences business have a little way to go, but less than in our life sciences. I hope that answers the question.
Both of them, yeah, thanks very much. To elaborate a bit, please, on your acquisition process. Are you working together with a property developer? And why would they prefer to work with you? And can I, sort of add a supplementary on that, which is about the acquisitions and the pipeline. So your pipeline is split between office and industrial. Clearly, the transactions come when the transactions come. But given what you were saying earlier on the medtech, the life sciences, without giving away any details, are there a number of live ones that are maybe almost ready to press the button on were you to have the capital on the life sciences?
Let's take this backwards. I mean, typically, whilst we're always trying to originate, in other words, we have relationships, we discuss with potential counterparts, vendors, what we would like. We don't commit or even say we're going to commit to a building until we know we have the wherewithal to buy it. The reason is we've developed a reputation of doing what we say, and it's quite important to us that we keep that reputation. So we will often be in conversation with people for some time, but until we know we can afford to buy something, we don't take them over that line. So we have a number of discussions on life science buildings, which we will not firm up until we know the capital is available. A lot of those vendors on that side often are public bodies, and therefore there's a slight bit of bureaucracy on the vendor side. The second thing, and there's a question about do we work with a property developer? It's very much the reverse. What we tend to do is there are a number of developers who we know and we like, and typically there will be one or two relationships. One, they've developed buildings which they would like to sell. And there are often buildings that we actually like, but what I've just said applies equally to them. We'll talk to them about the buildings, we will discuss with them a price that we believe is appropriate. They'll either tell us we're offering too little, or they'll be interested. but we won't get to the point of saying we'd like to transact until we know we can. But those relationships, we have a number of those relationships. We also have relationships with developers where our tenants, where we develop the opportunity, our tenant wants to build it, our tenant wants more space, and effectively we are working with the tenant to agree what they need, and we then work with the developer to say, in this instance, we would like you to do something, a fixed price contract, we know them well, therefore they can be insured, and that then allows us to say to the tenant, it will take you broadly this long, but in order for you to get the building, you're going to need to agree a lease at this lease rental rate. So the relationship is two-way with developers. We don't originate transactions with developers in the way that some people do, because we don't, for good or ill, we don't see ourselves as speculative. We'll build against an agreement to lease. We build, we get somebody to build for us, or we buy from developers where we can see the building being let and we believe there's demand to fill any vacancy. So that's the way we work on that side. I think once you're actually in the regions, so if we were buying properties in and around Dublin, there's absolutely no reason why they should prefer Yew Grove to anybody else. There are lots of people they could turn to. If you're operating, let's say, in Athlone or Galway, to a lesser extent Cork or Limerick, there are far fewer people with a track record of transacting. And when you say people transact, when you look at institutions, whether public or large private, you probably can see 4 or 5. There are lots of individuals with lots of money, but by and large, sellers like the security of dealing with an institution, not because we have more money. There are individuals with huge amounts of money, but because they know how the process will go. And often for those developers, the key point is having a secure process which will be kept quiet until it's done. Now, this is not a monopoly. There are, as I say, 3 or 4 people who do this. We're the only public one, but that's why we get the business we get.
Thank you. Yeah, there's a secondary question from Thomas that's come up, but also before that was David asking about equity raise, basically. And if I can just chuck in that you have had approval to raise your loan to value to 40% gross, and it's kind of currently around the 30% gross. But on the equity side, so David's saying, you mentioned at the end of the presentation, the shortage of equity, as you called it, and that you raised 12 and a bit million euro of the 100 million euro approved at the 2020 AGM. Could you outline your approach on placings? And interesting question, David, would they be at or below NAV?
To a large extent, we can't dictate how the placing should, who should invest. We're in the hands of our brokers in the market. Our view as a broad rule of thumb is, given the dividend history and outlook, and given the size of the company and liquidity, we are probably going to be more popular with small to medium-sized asset managers and high net worth and that type of investor than with large institutional shareholders for the time being. That doesn't mean through time we wouldn't get more large institutional shareholders. Whether or not, and the key for us is that we can raise sufficient capital to really make a difference in our pipeline. So this year we spent circa 19 million on new properties, and we committed approximately 10 million to a development. We raised 13.35 million earlier in the year, and that is all of our spare capital for the time being has been committed to those 3 transactions. So we've charged our brokers we're doing a roadshow, principally talking to existing investors plus some new investors, and we've charged the brokers to test the waters for us. And if there is sufficient interest in the business, we will raise capital. As is normal, we would expect that investors or prospective investors would suggest at what level they would invest. My own view is that today we are sufficiently strong to expect to raise money, at or very close to NAV. But I haven't had any feedback from the brokers, so it would be presumptuous of me to say that's what people would invest.
And Thomas was just asking about Aldi as one of your tenants, and is Aldi still expanding? And if we can enlarge that a little bit on, you know, your benefits to expanding tenants, but is Aldi looking to expand?
Yeah. Well, first of all, I need to explain this is not an Aldi supermarket, or this is Aldi's. It's an office, and Aldi uses it as the place that they test out new menus and new ideas. So it's a research group of Aldi. Aldi is expanding in Ireland significantly. I think they have a 1 million square foot warehouse about 10 miles away, 15 miles away. But I don't expect that to expand per se. Most of our tenants, not all of them, most of our tenants are either expanding. In life sciences, they're expanding. The office tenants are going through views on where they should be, but most tenants are expanding and deciding what their space should look like. The key for us is that building against agreements for lease comes when a specific tenant needs space which is not available. If you're in and around Dublin, there is office space to be had. So it's unusual that a tenant would come to you and say, build me something. If you're in the regions, that is less true. So, you know, this is very much a horses for courses, or places, location.
Maybe it's a question expecting the answer no, but it's one of the reasons why you're holding back a little bit of capex under that LTV sort of ceiling, because you are discussing with various tenants that obviously we can't mention, that might be looking to grow. And if one of those comes up with a strong proposition, you don't want to have to go around raising equity. You would be able to do a large expansion like the Athlone physical expansion, and that would be off debt.
That would be a very nice answer. I think the answer is a lot simpler than that.
Yeah.
We bought 2 new assets, and those assets are not yet in the loan facility.
Yeah,
they are moving into the loan facility, and that will expand capacity, and we'll be able to draw from that. The development we're doing in Athlone, because it's a development and because it's an extension on an existing building, meant both the existing building and the extension are not available under the facility until completed. So what we have is we have capacity in the existing portfolio, in the existing facility, but as any good corporate would have, we have to hold money back for, just in case. And we have capacity which will be released as the new assets go into the portfolio and the assets in Athlone is completed. So, that will release enough money to perhaps buy another building, but it's not there today.
Right. So I'm still sitting here spending your money for you about ESG. The climate change. You talk quite a bit actually in the results and in the report and accounts about E, S, and G, but particularly the E side of things. Can you talk a little bit more about that? And as an analyst, I believe that will slightly impact on your profits negatively in the short term, but clearly you're doing it to add value to your finances as well as the world.
Yeah, I think if I look at the sustainability, whether it's the environmental impact of the sustainability of building, I think as a landlord, ignoring any social responsibility for the time being, not because we don't care, but just setting that on one side.
The money side of it, yeah.
Yeah, I think what you look to is you want to maximize or optimize the rental value, and you want to ensure that the building stays valuable or will increase in value. So we have situations, for example, our Millennium Park portfolio, the one that was in the asset management slide, the buildings there are circa 15 years old, nice buildings, but nothing special. They wouldn't look very nice in the city centre, but they're on a very green park where we've done lots of work, planting sustainable plants, putting beehives in. We've put LED lighting into the car park and the common areas. Those buildings actually have a very good environmental quality. And from just a pure environmental quality, even as buildings, they don't look spectacular. That doesn't cost a lot of money, and it improves the potential rental value of those buildings. When you get a building in the city centre, we have buildings near the North Docks, the Gateway buildings, which are much nicer offices, albeit they are 12 years old or so. In order for those buildings to generate the best rent possible, we have to consider whether we're going to spend a significant amount of money to bring them up to, let's say, LED silver, or we'll take a lower rent and just leave them as is, but just improve them slightly. Now, clearly, an LED silver will give us a much better sustainability return. But for me, that is an economic decision. Eventually, we will have to do something. The question is, when is the best time to do that, and what gives us our best return? So we will continually improve the portfolio from an ESG perspective, but we won't do that absent economic issues. And I think if we do nothing, the buildings decay in value and our rents go down. The real issue as a landlord is timing that so we optimize that curve, and so we don't damage the returns to our investors and we protect the value of the balance sheet.
So clearly lots of moving parts, and clearly the Republic of Ireland has been very, very attractive and has continued to be through the lockdown and presumably is now. But there's talk about global, there's actuality about global tax rates and so forth. This is purely speculation, but do you have any view on FDI, and if you can perhaps just remind the audience about how useful it is and how many of your tenants are from that background?
Yeah, so addressing the tax question, the corporate tax rate in Ireland is 12.5%. The Global Tax Initiative has suggested a minimum tax rate of 15%. Speaking entirely personally for the moment, I wish and I hope that the Irish government just changes their rate to 15%, because that would, and it may be that they're going to do that. I don't know anything about Irish government policy. It would make no difference to FDIs if the local rate was 15% as opposed to 12.5%. It would just get rid of noise. It's quite clear that companies like being in Ireland. The corporate tax stake in Ireland has increased year on year very significantly. It's also quite clear as far as our portfolio is concerned. I don't pretend to talk for all FDIs, but our tenants are large employers. They employ a number of people, and those are very highly paid people. And when we look at their local accounts, they pay tax. These are not non-tax paying companies. So they are not there for some fiscal reason. They're there because Ireland's in the EU, they have smart employees and lots of them, and they are in a jurisdiction legally and from a language perspective they like. And frankly, Brexit has been a dividend, even though the Irish for a number of years thought it would be a disaster. So that is all positive. Sorry, now I've lost track of the second half of the question. I apologize.
No, that's fine. It was just highlighting, obviously, and just a lot of your tenants are multinational.
Oh, yeah. Sorry, you asked us. We have just under 30% government. And because we are, if I exclude the non-core buildings, that has eliminated all of the retail. And I think the rest of our tenants there are a couple of larger Irish corporates. There are a couple of people we define as SMEs, even though they're large companies, we define them as SMEs because of their capital base. And I think it's 67% FDIs. I was looking at Charles there in case I misstated it. I think it's about 67%.
I've got one more question that's come in. We can squeeze in because I think that the time is mounting a bit. So thanks for the extra question. What's the average debt financing cost and debt structure? And do you expect savings via refinancing? And as an analyst, I can say that it's slightly complex in terms of the P&L, in terms of the bank fees, as opposed to the ongoing interest costs.
Yeah. At our current LTV and increased LTV, we borrow at Euribor plus 2.4%. If the LTV goes down, that goes down to 2.2%. If we look to amortize all costs over the life, it's a revolving facility, and we look to amortize all costs over the life of that facility. So a broad rule of thumb is you can assume that our all-in costs are 3%. That includes all fees and etc. associated with it. 2 years to go, plus we have the option to extend by a year. The second half of the question was, could we reduce those costs through refinancing? The reduction of cost is fundamentally going to be that side. If we grow reasonably significantly, the private placement markets will open up. There is some capacity for us to have green loans because people like the work we're doing. When we improve buildings, the banks like the work we're doing. And as we grow in size, syndication opens up, albeit Ireland is a small banking market, therefore there are not many banks involved. So the answer is, if we stay as is, we've got a very nice rate for Ireland. High compared to the UK, but very nice for Ireland. If we grow, there is definitely the opportunity to refinance at better rates in due course.
But just as an overview, this is globally quite a small market, but the pipeline size that you're addressing is very significant. You've talked about quite a lot of opportunities that you've already secured, and you've demonstrated a really good performance in 2020, 2021. You are growing, and as a specialist, that should, I would have thought, be very attractive to investors.